Welcome back to The Explainer. I'm absolutely thrilled to have you here today. We're going to tackle a fundamental business concept that honestly trips up a lot of people, but it's totally essential for understanding the true financial health of literally any organization. We are demystifying depreciation and taking a really close look at the financial reality of wear and tear.
So think about this for a second. What actually happens to your company's value when that pristine, state-of-the-art equipment you bought 3 years ago starts getting, a little old, a bit rusty, or just outpaced by newer tech? I mean, the machines don't just vanish into thin air, right? But their value? It's definitely not what it used to be. Well, how a business accounts for that specific aging process is the entire secret behind today's topic. Let's get into it.
Here is our roadmap for today. First, we'll cover the end-of-year check. Second, we'll dive into the basics of depreciation. And finally, we'll break down the 3 methods of depreciation. All right, jumping right into Section 1, the end-of-year check. This is when accuracy really matters. Now, this whole accounting process doesn't just happen randomly on a Tuesday in the middle of July. It happens at a highly specific time, the end of the financial year. At this crucial milestone, a business draws up what's called a trial balance. And why do they do this? To check the sheer accuracy of their double-entry accounting system. It's essentially a massive financial health check. Once that initial accuracy is locked in and verified, we make our necessary adjustments, like say factoring in our aging equipment. And then we draw up another, final trial balance. This right here is the exact moment when the reality of depreciation officially enters the books. Moving right along to Section 2, the basics of depreciation. We're looking at fair and systematic value allocation. Okay, so when we depreciate an asset, we're basically looking at its initial value and the time it takes to lose its usefulness to us. Depreciation often gets a bad rap, but it is not a penalty. It's not money suddenly flying out of your bank account today. Rather, it's just the process of allocating a portion of an asset's loss of value to your expenses. And the key here is doing so fairly and systematically over the course of its economic life. You're simply aligning the cost of the machine with the actual usefulness you're getting out of it over time. Makes sense, right? To actually run the math on this, we first need our baseline, which is the depreciable amount. This is just the historical cost price of the asset spread over its estimated useful life. Think about it like this. You buy a delivery van for a set price. Boom, that's your historical cost. You estimate it's going to run well for about 5 years. That's your estimated useful life. Put those together, and you've got the exact amount you need to depreciate.
But what happens when year 1 rolls into year 2 and then year 3? Well, that is where accumulated depreciation comes in. If we tally up the depreciation we've provided for a particular asset over all those years, that running total is our accumulated depreciation. It's really the aggregate story of exactly how much value that specific asset has lost since the very day you bought it.
Now here is an absolutely crucial exception to the rule. We depreciate all non-current assets, sure, but land gets a free pass. Why? Because while other non-current assets, like laptops, factory machines, or vehicles, have a strictly limited lifespan due to physical wear and tear, land behaves entirely differently. Land actually appreciates in value over time. I mean, you can't really wear out a plot of dirt just by letting it sit there, right? So no depreciation for land. Okay, on to our final section, Section 3, 3 methods of depreciation. This is all about choosing your accounting philosophy. Before we get into the weeds of the specific methods, there is a golden rule in accounting that we absolutely have to establish. Consistency. Every single business has to choose a depreciation method that suits its specific accounting policy. And here's the kicker. They have to use that exact same method constantly, every single year. You can't just flip-flop between methods to make your financial statements look a little better for investors. Consistency is literally everything here. So when a business finally sits down to lock in that consistent policy, they generally have 3 core paths they can take.
Those 3 distinct approaches are the straight-line method, the diminishing balance method, and the production unit method. Let's look at how each one paints a slightly different picture of an asset's aging process.
Let's kick things off with Method 1, the straight-line method. In this approach, the useful life of the asset is the absolute deciding factor for figuring out the amount of depreciation we write off every year. It is super straightforward and perfectly linear. If an asset is expected to live for 10 years, you are just taking an equal, flat slice of its value off the books every single year for a decade. Simple as that. But hey, what if your asset is something like a high-tech computer server that loses most of its relevance in the first 2 years? That is exactly where Method 2 comes in, the diminishing balance method.
This approach allows a business to write off much larger amounts of depreciation in the earlier years of the asset's life. It totally reflects the reality that some things lose their value incredibly fast right out of the gate, and then sort of plateau as they get older.
So, how do we calculate that mathematically? You take the original cost, subtract the accumulated depreciation you've already claimed, and then multiply that resulting number by your set depreciation percentage. Because that accumulated depreciation grows larger every single year, the amount you're multiplying by the percentage actually shrinks every year. Hence the name, a diminishing balance.
And finally, we've got method 3, the units produced method. This one is super interesting, because for certain assets, their lifespan isn't tied to time, but entirely to physical output. Think of a massive printing press or a factory robotic arm. Time doesn't degrade it nearly as much as pure physical usage does. Therefore, depreciation is based entirely on the amount of unit capacity it is actually used up.
The formula here is great because it perfectly ties finance to physical reality. You take the original cost, divide it by the total unit capacity, which gives you the cost per single unit of output, and then you multiply that by the actual units produced in that specific financial year. It's incredibly scalable. If the machine works twice as hard this year, well, it depreciates twice as much. If it sits idle, it barely depreciates at all.
All right, so we've explored the end-of-year checks, the fair allocation of wear and tear, and the 3 consistent methods a business can use. Now, I want to leave you with this to chew on. As you look at the real-world operations around you, which depreciation method, straight line, diminishing balance, or units produced, tells the truest, most accurate story of how those assets actually lose their value? Think about how those choices completely shape a business's financial reality. Thanks so much for joining me for this explainer. Keep exploring, and I'll see you next time.